actually see that the majority of my clients are still bearish. And even when I look at fund flows, like let's take last week where we saw money market fund flows positive 27 billion. And even at the start of this year, we saw 140 billion fund flows out of equity funds. To me, that shows an investor that is pretty bearish still.
Yeah, Ron, it seems like the swoon that we saw in the last part of last year really did a doozy on sentiment, because you had Wall Street really tripping over themselves to lower their targets for the year. And here we are, we're pretty much either at or near their targets.
Well, the Fed can pivot a lot faster than large institutional investors. So they were all caught in the middle of a compressed bear market that saw some real carnage, whether it was in credit or whether it was in equities. We saw some pretty beaten up sectors in the fourth quarter. So they had to get reoriented rather quickly. So a lot of managers have trailed the market to a certain extent and trying to play catch up here. But I think it was really the Fed's pivot that caught everybody by surprise. We went from pricing in 3 hikes this year to 3 cuts.
Never seen anything.
Well, I would say that, 95, 97, and 98 were similar, but not to this extent.
Yeah. Michelle, where are you adding money and where are you withdrawing it, if at all?
Yeah, I would definitely say I'm adding money to the foreign markets, like Larry said, regarding that eventually they're going to catch up. I completely agree with that. You've got European markets trading at lower valuations and also a higher dividend, so I love that space. I would say commodities, right? They've definitely fallen behind the past 10 years. There's a chance that eventually inflation will pick up. Small and mid caps, I know you're laughing, like, will we ever see inflation again?
No, I'm not in that contrary camp.
But,
but the only reason I think that is because you have structural disinflation and deflation that's been holding commodities back.
Yeah, but when you think of agriculture prices, right, where the population is growing and we're going to need to feed all that population. But some of the places where I would consider to take back from is long-term bonds, right? Whether the Fed raises or not, I think long-term treasuries, 20 to 30 years, are probably overpriced here.
In terms of equities, Michelle, you've also said that you like healthcare specifically,
yes,
and European stocks. Are you going for the buy the laggards kind of mentality with markets at record highs?
Yeah, I always like the underdog. I'm a slave to looking at valuations. I like the dividend, particularly with the healthcare space. I look at the generational kind of fund flows, the generational cash flows. Let's face it, the silver economy, those that are in their 60s and 70s.
That'd be me.
I didn't look at you. I did not look at you.
That was the nicest way Ron and I have ever been described.
Silver economy.
So there's about 73 million baby boomers here in this country, and the United States says that in 2027 they're going to spend $6 trillion on healthcare. So how could you not be bullish on healthcare long term?
Unless you think they're political wins, which have buffeted healthcare year to date.
But I think it's a
silver men. Please, I'm asking a question.
Go ahead. No, answer the question.
What's the question?
In terms of it's gotten some headwinds because of all the Medicare for all. I think it's overblown.
It's overblown, even though, I mean, healthcare's what, up 6% or 7% or so year to date on a sector basis?
Yes, about 8%. Now, CVS, which I did note, is down 12% and trailing at a much lower valuation. So if you want to pick up an underdog, that might be the place to play.